Alright, there's a few things that I didn't cover in the last videos that I wanted to cover today, and also make a little bit of a comment on the results of the Fed meeting today and what that might mean going forward. So first, the chart we're looking at right now, this is sentimenttrader.com. I'm going to show several charts from there. This is a smart money, dumb money confidence chart that I've talked about before. This is the smart money confidence here. When the smart money confidence is low, that means they don't believe the market will be able to continue higher. When the dumb money is very high, that means that the less savvy market participants believe that the market will go higher. They're very bullish. And what we find is the smart money are good market timers, the dumb money are poor market timers. When both the smart money is extremely they believe the market will not rally to an extreme degree, and the dumb money is very bullish. This chart down here is a spread. When we see that spread get very wide, then that typically can mark either a market top in this case, if you look back through the chart at some of these other areas, and the converse would be true as well. So as of today's readings, the dumb money took a very big jump and is back at the highest levels of the bear market, and the smart money is back near the lows. So the spread is as wide as it's been since late 2006. So that's one reason for caution for bulls right now. Now another thing I want to show is a follow-up on the dollar video that I did, and I didn't mention this, and I don't think I've showed any of these charts before, but this is a chart, and it's called the public opinion, and it's a composite model based off of several surveys that give some type of investment view on the dollar. So it's similar to the advisor investor model I show for equities, but this pertains to the US dollar. And the thing I wanted to point out here is that divergence in this model. This is a chart of the dollar, so we see it going down here. At this low in the dollar, the opinion on the dollar was very bearish. Now the dollar has made an even lower low as of this last week, but the opinion is less bearish, so there's a divergence in higher lows on the indicator and lower lows in the dollar. And that divergence is actually something that will show up at significant market turns. For example, here where the dollar was higher, there was a pretty strong divergence, and the opinion was not more bullish. Same down here, as the dollar was making significant new lows early last year, the opinion was not making new lows. And you see the other examples of that up here, the dollar going higher, the opinion going lower, the dollar going lower here, the opinion going higher. So anyway, this is just showing that there is a divergence on this this opinion model that will tend to give a strong signal in the opposite direction. Now, I also wanted to show, here's a chart of unleaded gas, a similar model. We see kind of the same thing happening, a high in opinion here with this high. Now prices are right back at that level, but the opinion model is much lower. And again, that's a pretty strong divergence. So we might be seeing kind of a double top happen here, which would be almost the reverse of what happened in this area. You had the market fall, opinion get very low, the market bounced and then fell back to that low, but the opinion was much higher. So in this case there was a strong bullish divergence, and over here there's a strong bearish divergence with price. Another chart of notice, this is copper, same thing, public opinion chart. It's nearing its upper standard deviation band, which if you look back through this chart, whenever it has come up through this upper red band, it's kind of corresponded very closely with a peak. The copper is something that correlates really with a lot with housing and industrial output. So copper is not something I trade, but it is something that can be indicative of the expectation for growth in those building type of industries. This is a chart of a similar chart for crude oil, And again, you can see that price is almost forming a double top here, but the opinion is much lower, so we may be seeing somewhat of an extended topping process in the energy complex. And last one I'll show, this is gold, and gold will tend to move opposite of the US dollar over the long haul. The US dollar put its bear market low in right here when gold put its high in. It still hasn't broken that level. Now, if the dollar is bottoming right now, we're probably actually going to see gold start to drop. If that's the case, then what might be happening in gold right now, which I don't think many Elliott wave people will label it this way, but we might be seeing a pretty long-term advance in gold end with a contracting triangle where you have a leg up, an A, a B, a C, a D, and an E. So a contracting pattern right here. So if for chartists out there, if you draw a trend line up through here, if you see that trend line broken significantly on a closing basis, there might be an opportunity to actually short gold in this case with a stop above whatever high is made here. The most recent Investors Intelligence survey came out today. It comes out on Wednesdays. And this chart here shows the bullish percent of this survey. So again, this is investment advisors, and it's a survey of how bullish they are. They're either bullish, bearish, or expecting a correction. Now, this reading was the highest bullish percent of the entire bear market, going back to first week of 2008, last week of 2007. I'm going to scroll, show the bearish percent. This is an inverse scale, so the numbers decrease as you go up. The bearish percent is quite low. It's around 21% right now, and that's as low as it has been since the peak of the bull market, October 2007. And this chart shows the ratio of the two, the ratio of bulls to people who are bullish or bearish. And it's starting to get into the territory where, especially for a bear market, when you see this level of bull ratio, you have to take some warning. Now, in a bull market where the market's really rising strongly, like it did from 2003 to 2007, those readings are still usually good for a shorter term pullback, but maybe not a long-term signal. Whereas if you look back at the past bear market after the tech bubble, we saw that bullish ratio get pretty high here, and the market roll over pretty strongly after that. This chart is a chart of an up issues ratio. This is a breadth type of measurement. The up issues ratio means basically the percentage of stocks that closed higher out of stocks that either closed up or down on the day. And what to look for at market turning points here is divergence or a continuing move in the market in one direction with the up issues ratio not confirming that. In this case, the market has continued to trend higher over the last several weeks. But if you look at the 5, 10, 21-day averages of the up issues ratio, you can see a pretty strong tailing off or downward slope of that. So that means that the participation or stocks that are able to close up on the day has been waning over the last couple weeks, indicating there's somewhat of a decrease in breadth. Related indicator is the new high to new low ratio, the number of stocks that closed at a new high, 52-week high, divided by the stocks that closed at either 52-week highs or 52-week lows, the sum of those. And also 5, 10, and 21-day averages of that number. And we can see that all of these are stretched above levels that typically correspond with market peaks. And again, this is much more significant if this is a longer-term bear market. If it is a bull market, it'll still tend to lead to a slowing of the trend or a decrease in the strength of the trend before an actual correction would take place.